Hello and welcome to the Providence Quarterly Update for May 2023. My name is Michael Ogg and I'm joined by Grant Patterson, founder and CIO of Providence. Welcome, Grant.
Thanks, Mike.
I'm also joined by Mark Waits, our Head of Investment Strategy. Welcome, Mark.
Thanks, Mike.
Grant, if you don't mind, we'll start with you. The title of the Global Outlook and Strategy is What Lies Beneath? Can you please explain that?
Sure, Mike. We're really just now starting to see the ramifications of a previous period of extended low zero interest rates, increasing debt, free money, if you like, surging money supply, and indiscriminate investment behaviour, to a period now where very rapidly we've seen a very rapid increase in interest rates. We've seen a huge contraction, as you can see here in this chart, in money supply. We've had a supply disruptions due to COVID, and we've also had some geopolitical tensions, obviously, in Russia and Ukraine. And you can't have those sort of tectonic moves, in our view, without some stress coming through. And we've started to already see that. We've seen it, for example, in the UK pension system, which needed to be bailed out. We've seen it now in the US regional banks starting to unfold. We've seen it in some areas of commercial property. So these sort of hiccups are going to come through, and that's actually why we're quite excited, because it's going to present, you know, some very strong, good opportunities in these areas where some of these assets are going to be under pressure. There'll be a lack of capital available, and because we've got liquidity, we're quite keen to take advantage of that liquidity when these opportunities come.
So Grant, before we talk about the opportunities, which we will do, Mark, can I just ask you about the US central banks, or the US regional banks, I should say? You mentioned them a lot in the GOS. Can you just sort of expand on that?
So the importance of the US regional banks is the key role in credit provision that they have for the US economy. And that really encompasses both lending against commercial property, lending to small and medium-sized businesses. So they're a very, very important part of the sort of credit creation engine for the US economy. And so that kind of captures us front and center. If we look at why have they had problems, it's all come back to what Grant was talking about before in terms of the rapid rise in interest rates and the rapid contraction in money supply. And so that's hurt the banks both from a perspective of potentially some of their loans going bad, particularly in the commercial office space area, but also some of the depositors who had their money in the banks seeing better opportunities elsewhere. So they could take their money out of non-interest paying accounts and put them into the bond market.
Yeah, I mean, it's quite a different dynamic this time in the digital economy. I mean, one of the banks lost, I think, a third of their deposits within 36 hours, and that's because of a click of a button on your phone. And once you lose confidence, that can, you know, grow on a big feedback loop pretty quickly. And that's what we've seen in a number of the failures we've seen so far in the regional banks.
And I think just to add on to what Grant was talking about, what's very interesting is the central bank is trying to reduce the size of their balance sheet. So in a weekend, the central bank unwound all of the contraction in the balance sheet to support the regional banks that they've done over the last 5 months. So it's quite a momentous move, and it shows you how concerned they are about that sort of drop in confidence. I think if we say, so what does that mean for markets and the economy? I think it's very clear that it means a significant credit contraction in the US economy. And that really comes on the back of an environment where the senior loan officers survey from the US Federal Reserve is already showing pretty tight credit conditions in the US on the back of an environment where a lot of the debt markets were closed to new issuance, particularly to high yield companies, commercial mortgage-backed security companies financing real estate. So it just means that we should expect that there's going to be quite a meaningful credit contraction in the US.
So Mark, just on that, I mean, they're the largest global economy, and that obviously have ramifications elsewhere. So looking from a macro perspective, what does that mean for the US, and what does that mean for the rest of the world?
Well, I think it really sort of brings into play the potential, not the reality, but the potential for a hard landing. Indeed, we listened to an interview recently by the famous investor Stan Druckenmiller, and he's very much in that sort of hard landing camp, and he believes that sort of the sharp credit contraction can really hurt the economy. I think the other backdrop that's really interesting for the US economy is the mix of growth and inflation. We've been very privileged since the 1990s, where essentially growth and inflation has really shared a role in the economy. We've had a little bit of inflation, around about 2 and a bit percent, and we've typically had growth over the cycle of 2 to 3%. It's been very healthy. If we look at the forecast at the moment for the US economy, it's real GDP of 1% and inflation above 2.5%, closer to sort of 2.8%. Similar sort of story in Australia for 2024. So that's a different sort of dynamic for markets to digest and interpret and put some pressures in the economy.
And Mark, given that, how have portfolios performed for the last period, last quarter, and where are you seeing valuations at the moment?
So portfolios have performed well, and the portfolios have been well positioned for what's been a pretty sort of difficult macroeconomic environment. So we've had very strong performance in our portfolios from our exposure to gold. International equities has also done very well this year after having a difficult year last year. We've been very pleased with some of our international managers who've been invested in sort of the parts of the market that have done well during the sort of first quarter of this year. Australian equities have been a little bit less enthusiastic this year. There's been some noise around the banks. Resources have come off as concerns of growth have been there. And bonds have done really well. Having had a terrible year last year, as bonds have looked over the horizon, seen declining energy prices, inflation closer to sort of 3% rather than 7%, and essentially seeing the whites of the eyes of the central banks finishing their tightening cycle. So that's really helped the bond market.
Yeah, I think the real key, in the volatility that we've seen in markets, and this is a real dislocation, and I think somewhat the markets are a little bit benign to the realities of what's going on out there. Having the quality assets have held up pretty well in the volatile times that we've had, and so we haven't seen those big drawdowns or problems in assets. And then that's compounded, if you like, by having good diversification in the portfolio that protects that volatility.
Right, it's probably a good segue to yourself on the investment stance. So, what is the current investment stance that we have, and where are the opportunities that you're seeing?
Well, Mike, might surprise a lot of people, but we're becoming very positive and quite excited about the opportunities. We still think we've got some way to run. So the portfolios are still on a defensive, cautious tack, but we're starting to have a look at some opportunities that are likely to present themselves. And you don't, in my experience over 40 years, you don't get these opportunities that often. And now we're starting to see some attractive opportunities come. When you get a dislocation, normally you get some very good assets coming out at the beginning, and that's because of redemptions within certain funds. So we're taking advantage of that, particularly in a retail shopping centre that's coming out of a large institution. So there's some good opportunities there. These assets need to be repriced to the reality of a higher discount rate and a higher bond rate. So we're getting some better value in those sort of areas. Then after that, you'll start seeing some real distressed assets come into the market, whether they are unable to be refinanced, a lack of funding, lack of capital, as Mark was mentioning, or redemptions across the board. So we are now deploying with an international fund manager in distressed credit. We think that's going to be a good fishing ground over the next 12 to 18 months. We're having a look at distressed property, as I mentioned, that's now coming to market at big discounts to what they were recently and below replacement cost. And so that's attractive to us. Within equities, there's the one thing that is occurring is that although the index has been very strong, the performance of the index has been very narrow to a small number of stocks. So value is really starting to show up underneath the index in mid to small cap companies that are trading on pretty attractive multiples. So we're starting to look at that. And then also in equities, Japan, we're quite attracted to the activist movement in Japan, which is making boards much more accountable to shareholders and unlocking some value there. So, a number of opportunities coming through as we see price discovery from the private markets hit the reality of what's going on in listed markets. There's going to be some great opportunities.
Grant, sounds cautiously optimistic to me.
I am. We are.
Good to see. Now, Grant, any other updates on Providence you'd like to share with us?
Mike, there's a book that's come to our attention from one of our trusted partners in the industry, Jackie Clark, who's written a book, Stop Worrying About Money. It's an excellent book with some great tips in there for any of the younger generation looking to secure their financial future and financial security. It's a great read. If anyone would like a copy, please feel free to give us a call and we'll send a copy out to you.
Fantastic. Well, Grant, thank you very much for your time. Mark, thank you also very much for your time. And thank you for watching. If you'd like to get a copy of this book, please let us know. Or would you like to discuss anything further, please don't hesitate, give us a call. Until next time, thank you very much.